Happy March, everyone. February was one of those months where the headlines say deregulation, but the details say it's a lot more complicated, just like Valentine's Day. I am Stephanie Lyon, SVP of Regulatory and Risk Intelligence at Ncontracts, and joining me today is our team of experts. We have Director of Reg Intelligence, Robert Brosh, and we have someone who has sat in that practitioner's chair. We have Tony Fennell, who is our compliance risk expert. Let's start with the revival of fair lending enforcement coming out of the DOJ, and Robert is going to break it down for us.
That is right. So fair lending has definitely been the topic of deregulation. However, we did see a recent settlement from the Department of Justice against a lender for $68 million. That lender was targeting Hispanic borrowers for land sales, and they were doing that through Instagram and other social media platforms. And those advertisements, were exclusively in Spanish. They included national flags, had Latin music in the background, really to target that group of borrowers. The problem was that the land was susceptible to flooding, and it often lacked essential infrastructure such as water, sewer, and electricity, really what you need to actually build a home on the land. And the interest rates were extremely high, from about 11% to 13%, while a standard 20-year fixed rate loan averaged about 2.5 to 4 during that same time frame. There was also the fact that the lender didn't verify the applicant's ability to repay. And all of this kind of predatory activity did result in extremely high default and foreclosure rates. And so while the lender was operating unlawfully, and we saw that from the settlement, it is notable that $20 million of this settlement was for investment in increased law enforcement presence in the neighborhoods where that land was located. The current administration has stated that enforcement activity isn't going to be, weaponized like it was under the previous administration under President Biden. And we have seen that has meant less enforcement activity. But I think that this settlement indicates that the price of a violation has certainly increased. Non-compliance can lead to tacking on millions as a means to fund the current administration's objectives. And for financial institutions, really for what used to be an acceptable risk based on perhaps a lower idea of what the potential violation and the payment could be, that risk could now result in a crippling payout if your fair lending compliance slips. So it is important to note, for financial institutions that while disparate impact has kind of been pushed off to the side by the federal regulators because they have stated that they're only going to focus on overt discrimination and disparate treatment, that your lending data can still serve as a key risk indicator of those types of discrimination. Really, your statistical disparity should trigger you to conduct an overlap analysis. And then from there, you are able to identify areas where perhaps there's unmonitored discretion, and that is resulting in a higher fair lending risk. And that could be revealing a problematic loan officer or inconsistently applied exception criteria because of a lack of strong procedures and monitoring. So keep in mind, the settlement doesn't mean that the current administration is suddenly hyper-focused on fair lending, but it does show that they are not going to shy away from fair lending issues when they do come up. We also had a district court in the Northern District of Illinois dismiss a class action lawsuit alleging racial discrimination against a mortgage lender. And here the situation was the plaintiff alleged that she had received less favorable loan terms and was denied an option that would have reduced her interest rates if national rates decreased. And that the claim was that these were violations of the Equal Credit Opportunity Act and the Fair Housing Act. And she did use HMDA data to support her claim. But the court actually dismissed the suit because the complaint didn't meet the federal pleading standards for disparate treatment or disparate impact. And, specifically noteworthy around the disparate impact denial was because the plaintiff didn't sufficiently point to a policy or a practice that actually led to the disparity between white applicants and Black applicants. And this is actually now the second recent case that has led to dismissal because of a lack of connection between that statistical difference and a specific policy. So on the one hand, great news for financial institutions, right? Complaints do require more than simply showing statistical disparity, but you also have to make a connection or show causation between that disparity and something your institution has done, whether that is a policy, practice, system that you're using, for example. It is noteworthy. Different circuits differ on the level of causation there, so be careful based on where you are located. But what is also good is that the commonality needed for a class action, right? When a bunch of different plaintiffs want to come together and go after a financial institution together, they need to have some sort of common tie. And that level of showing or evidence is very high. Often the individual experiences of the members of the class action have different experiences, different ways that they've interacted with a financial institution. And that is difficult to prove that a single policy covers all of the plaintiffs involved. Great news, like I said, but on the other hand, financial institutions, I would say, absolutely still be wary. We are talking about private lawsuits here, but regulators, when it comes to enforcement actions, especially if we're talking about state regulators, they do have a broader reach because of their supervisory authority, right? They can go in, they can look at your specific loan files, your pricing policies, your underwriting manuals, and your exception data before filing a lawsuit, meaning that they're able to cover their bases a little bit more and that the risk is heightened in that type of situation.
Now let's turn to some genuinely good news for BSA officers. FinCEN made a change in February that our compliance teams have been asking for since 2016 when the rule came out. So back in February 13, FinCEN was feeling a little romantic and issued a relief from its 2016 customer due diligence rules, specifically the requirement to collect and verify beneficial ownership information every single time a legal entity customer opens a new account. For those of you who lived through the implementation of this rule, you know that it's pretty frustrating having to have a business customer come in on Monday, open an account, and then next week they want to have a CD and you have to recollect all the information, even though most likely nothing has changed. Especially if we look at the aggregate 100+ million accounts that are open every single day. That was a lot of process requirements, a lot of activity that was really not producing a lot of intelligence for FinCEN or any help for any of the legal actual aspects of this rule. So what is changing now is under the relief, you only need to collect beneficial ownership information from your legal entity in 3 situations. The first one is the first time the legal entity opens an account with your institution. That triggers the requirements. You're going to collect it at that point. The second time is when you learn that something has changed, something is no longer accurate, and that could come from your ongoing monitoring, from SAR filings, from news clips. Anytime you know that information you have is not accurate, we're going to recollect at that time again. And finally, the third opportunity is anytime that your own risk-based ongoing due diligence procedures mandate to do so, you can collect as well. So this relief is not telling you have to change your existing process. It's just making it a little bit easier should you choose to start collecting it at different times. So the relief really is moving that the mandate, but not your discretion. Also, in this specific relief, FinCEN did signal that they expect to change or start initiating formal rulemaking to completely amend the rest of the customer due diligence rule. So we'll stay tuned because we were supposed to have a lot of laws that were supposed to come down and affect that rule and make it easier for financial institutions. And it's been years and that has not materialized. So we are definitely watching to see how hopefully financial institutions won't be the ones required to collect information that is best required probably by the government, should they want that information. All right, let's go from BSA to AI, where Tony has the latest guidance on this topic.
Yeah, so let's talk a little AI. On February 18th, the U.S. Department of Treasury announced the conclusion of a major public and private initiative focusing on strengthening cybersecurity and risk management for artificial intelligence in the financial sector. So this effort was not a single report, but this is a series of resources developed in collaboration with financial institutions, regulators, industry stakeholders to support secure and resilient AI across the U.S. financial system. The following day after this report, the Treasury released the first of the two resources, a shared AI lexicon establishing common terminology across the sector, and the Financial Services AI Risk Management Framework, or FSAIRMF, because we do like some acronyms. These tools are designed to support responsible AI and to align with a broader national AI policy objectives. So why does this matter to compliance and risk teams? Our traditional risk frameworks were not built with AI in mind. Risks such as algorithm bias, limited model transparency, AI-specific cybersecurity exposures, and concentration risk that arises from shared AI service providers are often not fully addressed in our existing programs. The FSAIRMF was developed specifically to close those gaps. The framework was informed by extensive industry input and aligned to the NIST AI risk management framework, but it goes further by providing financial services specific control objectives tailored to real supervisory expectations. It's designed to complement and not replace your existing governance and risk structures. So for institutions that are already mapped to NIST, the FSAIRMF functions as a sector-specific layer that helps operationalize AI risk management and support exam readiness. In particular, it adds 4 areas that many current programs don't have. First is an adoption stage mapping. The framework recognizes that there are different points everybody's at a different point in our AI journey, and that controls should scale based on how and where we are using AI. Second, documented evidence. So rather than stopping at high-level principles, the framework emphasizes examiner-ready artifacts such as testing results, monitoring logs, governance documentation that demonstrate controls are actually operating as intended. Third, we have financial sector-specific risk statements, including fair lending, consumer protection risk. It also has third-party and concentration risk tied to shared AI providers and risk around emerging fraud, such as AI-enabled personation and deepfakes. And fourth is enterprise risk management integration. So AI cannot exist in a silo. The framework is designed to plug into your existing ERM structures, but institutions have to make that linkage in their current governance policies. It's also important to note that these Treasury resources are industry best practice. There's not a comprehensive federal AI law. However, institutions are not operating in a legal vacuum. There are several states that have already enacted or expanded their AI-related consumer protection and transparency requirement that impact financial services, and additional federal coordination efforts continue to evolve. The clear distinction at both the state and federal level is towards greater accountability, documentation, governance around AI use. Institutions that are establishing a strong AI risk foundation now are going to be better positioned when these expectations continue to mature. The Treasury has also indicated that additional resources are forthcoming. These are going to cover things such as governance, accountability, data integrity and security, fraud and digital identity, and operational resilience. So we're going to continue to monitor these developments and translate what they mean for your program. So we also have for our clients who are currently using NRIS, we do have an AI risk assessment template that's already aligned to the NIST framework, and we're actively working to incorporate this FSAI RMF so your assessments will remain aligned with the expectations.
Thank you, Tony. I know the industry is definitely excited to get some guidance on the governance piece and how to link it all together. We are moving on to the latest changes at the CFPB. The CFPB announced it intends to resume examiner activity by April 2026, but in a dramatically reduced form. We're talking 70 plus exams planned for the entire year. And if you compare what they were doing in the past, around 600 or so exams in the past few years, that is an 88% decrease in supervisory activity. All of these exams will be virtual with a very narrow focus on tangible, identifiable consumer harm. Try to say that 3 times really fast, with particular attention to your service members, military families, and veterans. Some examiners are being already reassigned out of this supervisory function entirely just to accommodate the lessening of the supervision function. And the practical message, in my opinion, here is that we should not be mistaking the fact that we have fewer exams for reduced legal exposure. We still have to contend with UDAP, fair lending, TILA, RESPA, COA, you name it, we have it, and all still on the books, still enforceable by a number of actors from state AGs to private plaintiffs and prudential banking regulators if you're not supervised directly by the CFPB. Also, from the CFPB this month, a quieter but a little more meaningful change here to consumer complaint portals for credit reporting disputes. The CFPB is now requiring consumers to dispute their issues directly with the credit reporting agencies. That would be your Equifax, Experian, TransUnion, and so forth, before filing with the Bureau. If a consumer files prematurely and goes directly to the portal, the Bureau may reject that complaint. The stated goal here is to reduce bot activity and mass dispute filings that have been driven by credit repair companies. And AI has only helped to make that even more of a volume driver. So credit complaints have actually hit over 2 million in 2024. That is over 180% increase in 2 years. So this was not a small problem that they were trying to solve. So the real question that you may ask yourself, well, is how does it impact furnishers like us, banks, credit unions, and other lenders? And you need to understand how the pipeline works here. When a consumer disputes something regarding their credit report, they have a few channels they can go to. They can go to the CRA, or they can come directly to your financial institution. If they go to the CRA, they have 30 days to investigate, and then they have to notify the furnisher within 5 business days of those errors or how to correct them. At that point, you, the furnisher, are legally required to investigate and to report back. And that is an indirect dispute, right? You can't just refuse to investigate it. You can't just pretend it's not there. But if the consumer chooses to come to you directly, then you also have 30 days to investigate and respond directly to your consumer. The CFPB portal change doesn't touch either one of those paths. It only affects what happens when a consumer tries to skip the CRA or skip your furnisher and file directly with the CFPB first. So the operational benefit for lenders is a little bit more indirect since you're not a CRA, right? But that hopefully means fewer premature complaints are going to reach the Bureau, and in turn, fewer premature complaints are going to be reaching you. That should give you a little bit of relief given the volume that our institutions have been absorbing. But here's what doesn't change. You still have FCRA furnisher obligations. Every indirect dispute that a CRA sends you, you still have to investigate. Every direct dispute from your customer, you still have to respond within 30 days. And you can't just start labeling disputes as frivolous to avoid them, because we have private plaintiffs who can still decide to sue you. And we also have prudential banking regulators who are looking at this specific key risk area, given the fact that there has been a lot of volume and a lot of issues regarding credit reporting. Now I'm going to send it back over to you, Tony, to cover a proposed rule coming out of the states that are pushing that Community Reinvestment Act even further than the federal law has.
Yeah, so let's talk about CRA, but community reinvestment. Illinois has proposed significant updates to its CRA rules. They published these on February 13th, and these apply to 3 distinct groups. So it's going to be state chartered banks, credit unions, and covered mortgage licensees. While the changes are going to vary different by institution type, the common thread running through all these is clarity, giving institutions and examiners a clearer, more consistent picture of what community development actually looks like in practice. The most significant change across all 3 groups is the introduction of new illustrated lists of qualifying CRA activities. These are detailed, non-exhaustive lists that provide concrete examples of the types of loans, investments, and services that may count towards the institution CRA performance. What makes these lists meaningful is the clarity they're going to bring, rather than leaving institutions to interpret broad community development categories on their own. Institutions and examiners will now have documented examples to reference across a wide range of activity types, such as affordable housing, small business financing, financial literacy programs. The list is also going to include activities around tribal and native lands and climate resilience. And this is going to be a reflect an evolving understanding of what community need really looks like today. It's important to note again that these are illustrative, not exhaustive lists, and it's clear that the inclusion of the list does not mean that the activity is automatically going to be safe, sound, or legally permissible for every institution. Each institution still needs to assess whether a listed activity is appropriate for its specific circumstance. For covered mortgage licensees specifically, the proposed amendments also expand the service test. So currently, the service test for mortgage companies evaluates how well they deliver mortgage lending services to low to moderate income individuals and geographies. The proposed update now includes a wider set of community development services, similar to those that are going to be available for banks and credit unions. This is really a meaningful shift for mortgage companies that have historically had fewer levers to allow them to demonstrate community development performance under Illinois CRA. So for institutions subject to CRA in Illinois, compliance and risk teams should be paying close attention to these proposed changes. The comment period is open for 45 days following that February 13th publication date, which means institutions have the opportunity to weigh in before the rules are finalized. So you should be reviewing the new list against your current community development activities and then understanding where existing program already aligns and where you may have gaps or new opportunities for upcoming examinations.
Let's move on to issues affecting depository institutions. Up first is an area that keeps heating up, especially as the states try to fill that perceived federal regulatory gap. So I'm, of course, talking about preemption. Who has to follow what laws and rules? Robert?
Yeah, Illinois has been busy, both in the court systems as well as in terms of the rules that the regulators are passing. But we are talking now about the Illinois Interchange Fee Prohibition Act. I'm going to probably shorten that to IFPA as I go through this. We've seen a lot of back and forth historically. At first, the interchange restrictions or requirements were delayed for national banks and out-of-state state-chartered banks, but federal credit unions were not included in that delay. But we now have a final ruling stating that for all financial institutions, that the provision that prohibits the charging of interchange fees on the state and local tax and gratuity parts of electronic transactions, that is prohibited. So that is not preempted by the National Bank Act or the Federal Credit Union Act. And the court's ruling was based on the fact that financial institutions don't actually charge the interchange fees. Instead, it is the card networks that do. And therefore, the statute doesn't directly regulate banks' powers. So what does that mean for financial institutions? It means that the interchange fee restrictions that require merchants to transmit the tax and gratuity information as part of a transaction is required. And the merchant has up to 180 days to submit relevant documentation on what portion of the transaction, the tax and gratuity is. And then that in turn triggers a 30-day window in which your institution, if you are a card issuer, you have to credit the merchant for the excess interchange fees. And there's not currently an automated process to complete that information submission, which means card issuers should probably expect merchants to be manually submitting that information to your institutions under the IFPA. And it is a pretty hefty penalty. Card issuers, payment card networks, you are subject to a civil penalty of $1,000 per electronic payment transaction if you have received the tax and tip documentation and don't credit the merchant within that 30-day window. Good news is the trade associations, the American Bankers Association and America's Credit Unions, as well as a few state associations, are planning on appealing this ruling. So we'll see if there is a new injunction that is issued. And then also in good news, as part of the IFPA, there was also a provision on a data usage limitation that made it unlawful for financial institutions to distribute, exchange, transfer, disseminate, or use associated data from those interchanges unless you are facilitating or processing the electronic payment transaction as required by law. So that provision was struck down. The court said that, this can strain financial institutions, including national banks, out-of-state, state-chartered banks, and federal credit unions' powers under federal law. So data usage limitation struck down. The tax and gratuity interchange prohibition on those fees, that is now in place with a potential appeal coming.
Moving on to issues affecting banks, we do have news from the Federal Reserve, who issued a proposed rule to formally remove reputation risk from bank supervision as part of a coordinated industry-wide shift that we have been seeing since 2025 when the OCC, FDIC, FRB, NCUA all started to remove references to reputation risk from their examination handbooks. So the OCC and FDIC actually jointly issued a similar proposed rule to codify this removal, and it would explicitly prohibit examiners from taking adverse action based on reputation risk and barring those examiners from pressuring institutions to restrict services based on customers' political, religious, or social views, or what the proposal calls politically disfavorable lawful banking activities. That is exactly what the Fed's February proposal is also doing. So there's some parity between all the banking regulators. And all of them are using the exact same rationale that reputation risk is too vague, too subjective, susceptible to examiner discretion that might not be warranted. So here's the question I know most of you are asking, and that is, should we just stop using reputation risk altogether? And I think the answer is pretty nuanced. You want to review how this risk is being used at your institution. If you use reputation risk to exit relationships for gun dealers or for payday lenders or crypto firms, for example, regulators may view that as exactly the type of political motivated debanking that they're trying to eliminate. There is an executive order out there, active proposed rules that we just talked about, and the congressional scrutiny all pointed at that behavior. So using reputation risk to make account decisions without rigorous financial analysis underneath is what creates the real exposure at this time. But here's the thing, the risk that reputation risk is designed to capture has not just disappeared, right? A bank or credit union or anyone else caught up in money laundering scandals or data breaches, or if you're associated with a fraudulent business and you are enabling them by providing them payment services, you could suffer from real financial consequences. We're talking about deposit runoff, increased funding costs, loss of key relationships. So those are material financial risks. However, institutions who have been using reputation risk a little more loosely as a catch-all to exit certain industries or customers, they may find that without this rigorous analysis, you could see heightened regulatory risk. So my recommendation is not to just go out there and delete the concept, but to translate it, to make sure it's being used and mapped appropriately to underlying financial risk that it is creating. We are going to finish off with our issues affecting credit unions, where the last standing board member has announced he will be stepping down. So we'll see what the credit union industry is doing, right, Robert?
That's right. I feel like they're really taking advantage of the fact that they only have one director right now, because we are in our 6th round of deregulation proposals, probably with no end in sight. And that is part of the deregulation initiative, where the NCUA is undertaking the mission to remove obsolete regulations, as well as requirements that are overly burdensome or duplicated from the Federal Credit Union Act or other laws. So this round had a couple of proposals that focused specifically on management. One of those proposals was to remove the regulatory requirement for a credit union director to either already have had or to obtain expertise in finance and accounting within 6 months after their appointment. And the focus here, the aim, is to reduce the compliance burden on volunteer boards. I would say one kind of asterisk there is that the NCUA did note in this proposal, though, that it is going to continue to assess the capabilities of the board of directors and management to identify, measure, monitor, and control the risks of credit union activities and on that safe and sound operation. So, while this is a removal, I'd say especially, we might not have a lot of board of directors listening to the reg brief right now, but you as compliance officers within your institution, risk officers, right? It is important to realize, like, just because they don't necessarily have to have this on their resume, it still can impact your institution's ratings. Another proposal that we had was allowing federally insured credit unions to have flexibility to provide compensation plans that incorporate lending as part of a set of broad and balanced organizational goals and performance measures. And really the focus here is on the financial institution's overall financial performance and the incorporation of loan growth or loan performance metrics like delinquency rates into those compensation plans and bonuses. And by adding the definition of overall financial performance, NCUA is hoping that this will allow credit unions to recruit and retain staff better. And I think one little note here, I think it's important. Most of you probably know this, but this isn't a removal of the loan officer compensation rules for compensation based on terms and conditions of a loan. This is dealing with the overall institution's performance and tying that loan performance to compensation. A lot of proposals floating out there. I think definitely refer to NComply to see which get approved and which get cut and which get modified, because we will certainly be keeping you all up to date there.
Thank you so much, Robert. And that is a wrap on our March regulatory brief. As you have heard, February was a very busy month, and we know that we covered a lot. So just know that everything can be found in NComply. And on behalf of Tony, Robert, and myself, thank you so much. We will see you again next month.